What happens when the world's most powerful economy suddenly shuts off the energy lifeline of its closest neighbor? That's exactly what just happened. In a stunning move that's shaking both Washington and Ottawa, President Donald Trump, who's once again at the center of global headlines, has cut off oil exports to Canada. And the fallout is nothing short of explosive. Canada's economy, already facing challenges from inflation and global market volatility, is now staring down a potential collapse of energy supply chains. Businesses are scrambling, households are panicking, and Bank of Canada Governor Tiff Macklem, alongside Finance Minister Chrystia Freeland, is desperately trying to calm the storm. But perhaps the most fiery reaction came from former Bank of Canada Governor Mark Carney, who erupted in anger, warning that this move could devastate millions of Canadian families and destabilize North America's economic future. The question everyone's asking: is this a bold negotiation tactic by Trump, or a reckless gamble that risks destroying one of the world's closest partnerships? Let's break down exactly what happened, why it matters, and what could come next. For more than half a century, energy has been the backbone of U.S. Canada relations. The United States is Canada's largest supplier of crude oil, refined petroleum products, and natural gas. In fact, more than 60% of Canada's oil imports come directly from the U.S., fueling everything from airplanes to heating systems. That deep energy relationship has been so consistent that most Canadians and Americans never even think about it. But Trump's sudden decision to pull the plug on those oil shipments has shattered that sense of stability. Why now? Analysts say this move is tied to escalating trade disputes, Trump's aggressive America First agenda, and his belief that Canada hasn't been paying its fair share in energy and defense partnerships. The timing couldn't be worse for Canada. With inflation still eating into family budgets and global oil markets already tight due to geopolitical tensions in the Middle East and Russia losing access to U.S. oil is like pulling the rug out from under Canada's economy. And here's why this is such a big deal. Canada may be an energy-rich country, but much of its crude production is exported to the U.S. instead of being refined at home. That means Canadian refineries rely heavily on American imports to meet day-to-day needs. Cut that off, and you don't just get higher prices, you risk fuel shortages, factory slowdowns, and a domino effect that could hit jobs, investments, and even the political stability of the country. So what does this all mean for ordinary Canadians, for American consumers, and for the future of one of the closest economic relationships in the world? Let's break it down. Number 1. The very first and most immediate shockwave from Trump's oil cutoff is the sudden surge of energy insecurity across Canada. For decades, Canadians have lived with the assumption that affordable and reliable energy from the U.S. was practically guaranteed. That assumption just evaporated overnight. Without those oil shipments flowing steadily across the border, Canadian refineries are already scrambling to secure supplies. These refineries aren't simply plug-and-play facilities where you can swap in oil from anywhere in the world. Each refinery is engineered to process specific types of crude, and many of Canada's are optimized for U.S. blends. So when the flow stops, it's not just a matter of calling up another supplier. It's a structural challenge that can't be fixed in days or even weeks. The first visible sign Canadians may experience is at the gas pump. Drivers could wake up to find fuel prices doubling or even tripling in a matter of days. Think about what that means for an ordinary family. A long commute suddenly costs twice as much. Grocery deliveries become more expensive because truckers are paying more for diesel, and flights between major Canadian cities might see ticket prices jump. In a modern economy where nearly everything depends on transportation, higher fuel costs ripple into almost every corner of daily life. But the danger doesn't stop at consumer prices. Energy shortages also threaten Canada's industrial backbone. Major industries like auto manufacturing in Ontario or grain shipping in the prairies depend on stable energy inputs. When diesel costs surge and supply chains tighten, production slows down. That leads to layoffs, delayed shipments, and a chilling effect on investment. Companies hate uncertainty, and energy insecurity is one of the worst uncertainties of all. Local governments are also sounding alarms. Provinces that rely heavily on U.S. imports, like Quebec and Ontario, are in a particularly vulnerable spot. Municipal leaders are warning of potential heating oil shortages as winter approaches, raising fears of households literally being left in the cold. Hospitals, schools, and emergency services, all of which depend on reliable fuel, may also face budget shocks. All of this feeds into a larger psychological effect: panic. When ordinary people feel their most basic needs, like driving to work, heating their homes, or buying affordable groceries, are under threat, public trust begins to collapse. Panic buying at gas stations could trigger further shortages, creating a vicious cycle that's hard to break. In short, the cutoff isn't just an economic problem, it's a social and political crisis unfolding in real time. Number 28. If the energy crisis itself wasn't enough, the political fallout from this move is turning into a firestorm that threatens to reshape Canadian politics. Prime Minister Justin Trudeau and his government have been thrown into one of their toughest challenges yet. Almost immediately after Trump's announcement, opposition leaders seized the opportunity to hammer the government, accusing Trudeau of leaving the country dangerously dependent on U.S. energy and failing to develop long-term alternatives. In Parliament, the atmosphere is growing tense, with calls for emergency debates and accusations flying across the aisle. For Trudeau, the pressure is twofold. On one hand, he needs to show Canadians that he can deliver quick solutions to prevent shortages. That means scrambling to line up new deals with alternative suppliers like Saudi Arabia, Venezuela, or Nigeria. But these options come with their own complications. Shipping crude across the Atlantic takes time and raises costs, and many Canadians are deeply uneasy about relying on regimes with questionable human rights records. On the other hand, the Prime Minister faces pressure to accelerate domestic solutions, like expanding refining capacity or increasing pipeline capacity from Western Canada. But those are long-term projects that cannot solve today's crisis. Meanwhile, Mark Carney's eruption of anger reflects a deeper fear among Canada's financial and political elite that this crisis could shake the very foundations of the Canadian economy. Carney, known globally as a steady hand during past financial shocks, has warned that the oil cutoff could undermine investor confidence and lead to prolonged economic instability. His words carry weight not just in Canada but around the world, and they add fuel to the debate over how prepared, or unprepared, Canada truly is for energy disruptions. Opposition leaders are using the crisis to paint Trudeau as weak in the face of Trump's aggressive tactics. Some are calling for retaliatory measures, like restricting Canadian exports of raw materials to the U.S. or imposing tariffs. Others argue that retaliation would only escalate tensions and hurt Canadians even more. That split is sowing division not just in Parliament, but also across the broader public. Polls are already showing declining confidence in the government's handling of the crisis. This political battle is also stoking broader questions about Canada's future energy strategy. Should the country double down on building its own refining capacity to reduce dependence on imports? Should it pivot harder toward renewable energy to escape the volatility of fossil fuel politics? Or should it seek closer energy ties with Europe and Asia? Even if that means turning away from its closest ally, each of these choices comes with enormous political consequences, and Canadians are watching closely to see whether their leaders can navigate through the storm. Number 3's on the U.S. side of this story. Trump's move is being framed not as an act of hostility but as a strategic play, a bargaining chip designed to give Washington more leverage in its ongoing disputes with Ottawa. Supporters of Trump argue that Canada has long benefited from American generosity when it comes to trade, energy, and security. They say cutting off oil is a way of sending a sharp reminder the United States holds the upper hand, and Canada needs to step up if it wants to keep reaping those benefits. The logic here ties back to Trump's signature "America First" approach. He has repeatedly claimed that U.S. allies, including Canada, have failed to carry their fair share of the burden, whether in NATO defense spending, cross-border trade agreements, or infrastructure investments like pipelines. To Trump and his allies, pulling the plug on oil exports is a bold way to force Canada to the negotiating table and secure concessions. The message is simple: if you want America's energy, then give America what it wants in return. But critics see it very differently. To them, this isn't savvy negotiation, it's economic blackmail. By deliberately weaponizing something as vital as energy, Trump risks undermining not just Canada's trust, but also the broader trust of U.S. allies around the world. If America is willing to cut off its closest trading partner and neighbor overnight, why would other countries believe that their partnerships are secure? That perception could drive allies to seek alternative alliances, gradually eroding the United States' global influence. There's also the risk of unintended consequences. If Canada feels backed into a corner, it may accelerate efforts to pivot away from U.S. dependence altogether. That could mean forging closer energy ties with China, which has been eager to expand its presence in Canada's resource sector. Or it could mean expanding exports to Europe, where countries are desperate to reduce reliance on Russian energy. Either way, the long-term effect could be a weakened U.S. position in North America, exactly the opposite of what Trump intends. Within the U.S. itself, reactions are divided. Some Republican lawmakers are praising Trump's toughness, arguing that the move demonstrates strength. Others, including moderates and Democrats, warn that the decision is reckless and could spark retaliation that harms U.S. industries. Farmers, automakers, and manufacturers who depend on cross-border supply chains are especially nervous. If Canada decides to push back with trade restrictions of its own, American jobs could be on the line. In short, what Trump sees as leverage may also be laying the groundwork for long-term damage. Using oil as a political weapon might win short-term concessions, but it risks reshaping Canada's energy future in ways that leave the U.S. with less influence, not more. Number 4A. While the political battles rage, the financial markets are already delivering their verdict on this crisis, and the reaction has been swift and brutal. Within hours of the announcement that U.S. oil exports to Canada were being cut off, global oil prices began to climb. Traders fear that any disruption to North America's tightly integrated energy market could ripple outward, tightening global supplies and pushing prices higher worldwide. In a market that was already jittery due to conflicts in the Middle East and ongoing sanctions against Russia, this move added fuel to the fire. For Canada, the pain is especially sharp. The Canadian dollar, known as the loonie, immediately tumbled against the U.S. dollar. A weaker currency makes imports, everything from food to electronics, more expensive, worsening inflation that Canadian families are already struggling with. Investors also began pulling money out of Canadian equities, worried that rising energy costs could drag the entire economy into recession. For ordinary Canadians, this means higher costs at the store, more expensive mortgages as interest rates remain high, and an overall sense of financial insecurity. The stock market reaction wasn't limited to Canada. In the U.S., shares of energy companies rose as traders speculated that American producers could benefit from the new leverage. But at the same time, airline stocks and shipping companies fell, as higher fuel costs threatened profitability. Even American consumers are likely to feel the squeeze, because when global oil prices rise, gas stations across the United States raise prices too. That's the paradox of Trump's move. While it's intended to hurt Canada, it risks boomeranging back onto U.S. households. Canadian industries are especially vulnerable. Auto manufacturing, for example, relies on just-in-time supply chains that stretch across the U.S.-Canada border. When energy costs spike, the price of shipping parts rises, which threatens production schedules. Agricultural exports are also at risk. Farmers who rely on affordable diesel to run tractors and ship crops could find themselves squeezed between higher costs and uncertain markets. Investors fear a scenario where industries slow down, jobs are lost, and Canada slips into a deep recession. Meanwhile, global investors are watching closely. If Canada's G7 economy enters crisis mode, the ripple effects could destabilize broader financial markets. Pension funds, hedge funds, and major banks all have significant exposure to Canadian assets. A shock in Canada could quickly become a global problem. In short, the markets are treating Trump's oil cutoff not as a temporary spat, but as a potentially seismic event. Prices, currencies, and stocks are all flashing red warning lights. And while politicians argue about blame and solutions, the financial world has already made up its mind. This crisis is real, and it's dangerous. Number 50. The most important question in all of this isn't just what happens today or tomorrow, but what this crisis means for the long-term future of Canada's energy strategy and its relationship with the United States. If Trump's oil cutoff remains in place, or even if it's quickly reversed, the message is clear: Canada can no longer take American energy for granted. That realization could trigger a seismic shift in how Canada powers its economy. for decades Canada has been caught in a paradox. On one hand, it is one of the world's largest producers of crude oil, exporting massive quantities from Alberta's oil sands and other regions. On the other hand, because much of that crude flows south to U.S. refineries, Canada has been forced to import refined petroleum products, like gasoline and diesel, back from the U.S. This has left the country vulnerable, as this crisis demonstrates. Breaking that cycle could become a national priority. One possible response is accelerating domestic refining capacity. Building or expanding refineries would allow Canada to process more of its own crude at home, reducing reliance on American imports. But that's easier said than done. Refineries are incredibly expensive, take years to build, and face environmental and regulatory hurdles. Still, if the political will is there, this crisis could provide the push to finally make it happen. Another long-term implication is diversification of energy partners. Canada may begin seeking stronger energy ties with Europe and Asia, especially as those regions look for alternatives to Russian energy. This could mean building new pipelines to the Pacific coast for export to Asian markets or expanding liquefied natural gas (LNG) terminals to ship to Europe. In doing so, Canada would reduce its dependence on the U.S., but it would also reshape global energy flows, giving countries like Japan, South Korea, and Germany new lifelines. There's also the question of renewables. This crisis could add momentum to Canada's investments in clean energy, from hydroelectric power to wind and solar. If oil can be weaponized, then developing a more resilient, homegrown energy mix could become a matter of national security. While renewables can't replace oil overnight, accelerating that transition could make Canada less vulnerable to future shocks. For the U.S., these shifts carry risks. Losing its role as Canada's dominant energy partner would weaken America's economic influence in North America. What looks like a bold pressure tactic today could, in hindsight, be remembered as the moment Canada charted a new, more independent course. In other words, this crisis isn't just about high gas prices or political fights. It's about the possibility of an energy realignment that could reshape the North American economy for decades to come. So here we are, a shocking move from Trump, a furious reaction from Canadian leaders like Mark Carney, and a future that looks more uncertain than ever. The oil taps may have been turned off, but the real story is just beginning. Will Canada bend under pressure, or will this crisis push it to break free from U.S. energy dependence once and for all? And what does that mean for the millions of people on both sides of the border whose daily lives depend on affordable energy? One thing is clear: this is not just a story about oil. It's a story about power politics and the fragile bonds that hold nations together. Stay tuned, because this showdown is far from over.